Hey guys, welcome back. As promised, in this video I'm going to show you my number one tool that I use every single day to determine whether there's actual real fear or artificial fear in the market. Now this tool is being used by fund managers across the world, but I believe that many of them are using it in the incorrect way. And the tool I'm talking about is the Volatility Index, or the VIX for short. And this is the number one tool that you need to be paying attention to, because this is what's going to guide you in and out of the markets. Now we can actually access the history of the VIX going back 30-40 years or more. And if we study the charts, we can see very clearly when every major financial crash has occurred. So if you look at the chart, you can see very clearly when 9/11 happened. We can see the global financial crisis of 2008. We can see the US credit downgrade of 2011. And we can see the Chinese energy crisis. Now, if you study the VIX try to pre-warn us prior to every one of these major events. So the VIX is the thing that I use every day to determine whether I should be trading or whether I should be holding back. Now, let's switch over to the charts and I'll show you exactly how the VIX works. Now, just before we do, I'll let you know that I do use many other indicators. In fact, I use about 7 other indicators in conjunction with the VIX. But the VIX is probably one of the most important, and that's why our focus today is going to be on the VIX. Let's switch over to the charts and I'll show you exactly how it works.
So in front of you, you'll see a chart of the Volatility Index, or the VIX. And what I've done is I've plotted every major financial crash or pullback that we've had over the last 10 years or so. So on the screen, you can clearly see the Brexit of 2016, the Chinese and energy market shock of 2015, the US ratings downgrade of 2011, the European crisis of 2010, and most importantly, the global financial crisis of 2008. Now, the main thing I want you to take note of is that every time the VIX spikes above the 30 mark, the markets have a major pullback or correction. As you can see, every single one of these events, excluding the Brexit of 2016, actually spiked above the 30 mark. So every time this happens, the markets pull back. So if the VIX is above 30, what I do is I completely stop trading, I close out any of my positions, and I won't actually enter any new positions until the volatility begins to fall back below 30. Now we want to see the volatility pull back below 20, where I've drawn the green line. Because anytime the VIX is below 20, that's when it's the safest to trade. So as long as the VIX stays below 20, I'm trading in and out of stocks as per normal. But as soon as it starts to get up about that 20 mark and starts to push higher, we have to watch it carefully. So when the VIX is between 20 and 30, I don't actually enter any new positions. I don't close any of my positions, but I watch the markets every single day to try and determine which way it's going to go. If it starts to close above 20, that's when we want to start to be cautious. If the VIX pushes up to 25 or 30, but then immediately rebounds and starts to fall, that's when we can actually find some opportunities, because as the VIX starts to pull back, the market starts to rise. So the VIX is what determines the direction of the markets. This is the tool that you need to be looking at every single day. So whenever you hear any market noise in the media or the news channels, the first thing to do is go into the VIX, have a look at it, see where it's sitting. Most importantly, the VIX is that golden tool that's going to confirm whether we should be cautious or whether whatever news we see in the media is just noise. So this is like your crystal ball. This determines the direction of the market. So as long as the VIX stays below 20, it's safe to trade. And what you'll notice is the media try to paint the volatility as this big scary thing. They overhype it, they oversell it, they try to create fear in the market. And if you're one of those people that follows these news outlets, well, you could get caught in that artificial fear. So when there's uncertainty in the market, investors panic and they pull out of the markets. Us smart investors come to the VIX and we let the VIX determine whether we should be pulling out or whether we should hold on and let the market noise die off. And this is generally the time where most good opportunities are created, because as the VIX starts to drop and we know it's dropping, we can then go on the hunt for new trading opportunities. As you can see in the Brexit of 2016, there was a lot of fear in the market at the time. There was a lot of panic. And the VIX did spike above 20. It actually pushed up above 25. So that range is now going into a high risk or high volatile market. But as you can see, it immediately turned around and pulled back below 20. And in fact, during that period, there was some fantastic trading opportunities that we actually took advantage of. So it's important to remember that the markets will always do the exact opposite of what the VIX is doing. So if the VIX is rising, the markets should be falling. And if the VIX is falling, the markets will start to rise. And if you look at the chart of the Volatility Index and compare it to the S&P 500 chart, the SPX, you'll see as one rises, the other falls. They are directly correlated. So I'll switch to the live chart to demonstrate how that works. And as you can see here, I'll zoom into the Brexit of 2016. The peak of that spike was on the 24th of June of 2016. As you can see, this candle here. So you can see the volatility, and I'll just zoom in a bit better. So the volatility spiked right up, closed above 25, but then the very next day we got this red candle here, and that's a typical reversal candle. So on that day there, if I go to the actual market, that's it there. So the Brexit was on the 24th of June 2016. You see a massive red candle there. So the market actually fell as the VIX spiked up. Okay, and then the following day, which was the 27th of June, which was the Monday, the markets continued to fall. But if you notice that there's the 27th of June, so that's when we got the reversal candle. And as soon as I saw that reversal candle, I knew that there was some trading opportunities on that day. And on that day, we entered some trades. And as you can see, the following day, the volatility continued to drop. See that massive red candle there? At the same time, the market took off. See that big green candle there? That's the day the market actually took off. So that's the day we actually entered some new trading positions. And not only did it take off, it actually broke above its highest peak there, and it continued to rally. I'll give you another example. If we scroll up to the election of 2016, so if you recall how much uncertainty and how much fear was in the market prior to the election or leading up to the election, there was a lot of negative media hype. But on the day of the election, November 9 of 2016, we saw this massive push up in the market. And if we go back to the VIX, we'll see a massive drop in the market. There's the US election there. So as soon as Trump won, as soon as it was confirmed that Trump won the presidency, the volatility just dropped. Everyone in the media was speculating that if Trump won, the markets were going to fall. But if we looked at the VIX told us a completely different story. The VIX was telling us that it actually didn't care that Trump won. In fact, it saw that as positive for the market. So as the VIX dropped, the markets rose. And again, not only did they rise on that day, they actually continued to rise, and it hasn't stopped. Look how far the market has risen since that election. So any trades we entered here would have done fantastically well if we were still holding them. Had I given into the fear at the time, I would have missed out on all these gains we made on these trades. So the key takeaway here is that the VIX is what determines which way the market is going, and the VIX is the one thing you should be looking at every single day. And later on, when I demonstrate how I analyze the market, you'll see me talk about the VIX more and more. Now, to access the VIX, it's really quite simple. I'm using a paid piece of software, which is Market Analyst, but it costs about $500 to $600 a year to use. But if you're just starting out, there's no need for expensive software. There's a free online platform that you guys can use to access all the charts, and I'll just bring it up to demonstrate. So if you just go to stockcharts.com, and if you just type in VIX to bring the VIX, it'll give you the chart of the VIX. And I'll just open another tab and open the actual market, the S&P 500. You can see that as the market is rising, the VIX has been falling for the last few weeks. So the VIX and the market are directly correlated, and it's important to know that. Now, there are other tools that I also use with the VIX. I don't just use the VIX on its own, but in this video, I wanted to highlight the importance of the correlation between the market and the volatility index. I'll see you in the next video.